Imagine waking up on a Wednesday. No alarm, coffee in hand, you check your phone and another dividend payment landed overnight. That sounds like a fantasy, but it is not magic. It is a system. And the question is simple. How much money would you actually need invested to live off dividends in Australia? $700,000? $1 million? $2.5 million? Today, we're going through the 9 numbers that answer it. Franking credits, your lifestyle number, the portfolio size, the tax reality, the investing path, super, ETFs, the traps, and the snowball. Because dividend freedom is not one number, it is a full system. Number 1. Why Australia is built for dividend investors. Australia has one feature that makes dividend investing different: franking credits. Plain English version: a company earns profit. The company pays tax. Then it pays you a dividend from what is left. Without franking, the same profit can effectively get taxed twice. Once inside the company, then again in your hands. Franking credits are Australia's way of saying, hang on, tax has already been paid on this profit. Here is the simple example. A company earns $100 of profit. It pays $30 in company tax. Then it pays you the remaining $70 as a fully franked dividend. But your dividend statement does not just show $70. It also shows a $30 franking credit. So the ATO treats it like $100 of income with $30 of tax already prepaid. That is the advantage. Not fake maths, tax system maths. And this changes the yield. A 4% fully franked cash yield, grossed up for 30% company tax, is roughly 5.7% before considering your personal tax position. So when Australians talk about dividends, you cannot just look at the headline yield. You have to ask, is it franked? How much is franked? And what does it mean after tax? What this means for you is that dividend income in Australia is not just cash paid into your account. It can also come with a tax credit sitting behind that cash. But before we calculate the portfolio, we need the most important number of all, your freedom number. Number 2, what freedom actually costs. Most dividend videos jump straight to, you need $1 million, but that is backwards, because one person's freedom is another person's grocery budget. ASFA's retirement standard estimates that for Australians aged 65 to 84, a single person needs about $36,434 a year for a modest lifestyle. For a comfortable lifestyle, it is about $55,923. For couples, ASFA puts a comfortable lifestyle at about $78,566 a year. But here is what ASFA cannot tell you: your number. Because your life is not average. Do you own your home, or are you renting? Are you in Sydney or regional Queensland? Do you want 2 overseas holidays a year, or are you happy with beach walks and good coffee? That changes everything. So here is the 2-minute exercise. Write down your annual spending target. Not your fantasy number, your real number. Start with housing, then food, then insurance, then transport, then health, then travel, then fun money. If that number is $50,000, great. If it is $75,000, fine. If it is $100,000, now we know the target. The portfolio comes second. The lifestyle comes first. What this means for you is simple. Do not copy someone else's retirement number. Build your own. Because now we can do the exact maths. Number 3, the exact portfolio size for any lifestyle. Here is the formula. Annual income divided by dividend yield equals portfolio size. That is it. If you want $50,000 a year and your portfolio yields 5.5%, you divide $50,000 by 0.055. That gives you about $909,000. But yield is not fixed. A broad ASX index fund might sit closer to a 3 or 4% cash yield. A high yield strategy might sit around 5 to 6%. A very aggressive dividend portfolio might show 7%. But the higher the yield, the more careful you need to be. Because yield can be income, or it can be a warning sign. So here are 3 scenarios. For $50,000 a year, at 4%, you need $1.25 million. At 5.5%, you need about $909,000. At 7%, you need about $714,000. For $75,000 a year, At 4%, you need $1.875 million. At 5.5%, you need about $1.36 million. At 7%, you need about $1.07 million. For $100,000 a year, at 4%, you need $2.5 million. At 5.5%, you need about $1.82 million. At 7%, you need about $1.43 million. And for $150,000 a year, at 4%, you need $3.75 million. At 5.5%, you need about $2.73 million. At 7%, you need about $2.14 million. This is why one person says you need $2.5 million, and another says you only need $900,000. They might both be right. They are just using different income targets and different yield assumptions. What this means for you is that the exact number depends on two things: how much income you want and how much yield you are willing to rely on. But the next question is the one everyone worries about. What happens when the ATO gets involved? Number 4. The tax reality. This is where dividend income scares people. They hear taxable income and think, so I build the portfolio, then the ATO takes half? No, that is not how fully franked dividends work. Let's walk through a simplified example. Assume you receive $50,000 in fully franked dividends. You have no other income. You are an Australian resident for tax purposes, and the franking is based on a 30% company tax rate. The cash dividend is $50,000. The franking credit is about $21,429. So your grossed up taxable income is about $71,429. The tax is then calculated on the grossed up amount. Using the 2026 to 2027 resident tax rates, the income tax before offsets is about $12,217. Then add the 2% Medicare levy, which is about $1,429. So the total tax before franking credits is about $13,646. The tax before credits is about $13,646. The franking credit is about $21,429. In this simplified example, the franking credit more than covers the tax bill. Now, do not take this as a promise. Your actual tax can change. If you have salary income, rental income, business income, capital gains, help debt, the Medicare levy surcharge, or partly franked dividends, the result changes. This is general education, not personal tax advice, but the principle is powerful. Franking credits mean you are not simply taxed again from zero. The system recognizes tax already paid by the company. What this means for you is that dividend tax is not simply your dividends multiplied by your tax rate. You gross up the income, calculate the tax, then apply the franking credit. That is the real maths. Now we know the target. We know the tax logic. The next question is the hard one. How do you actually get there? Number 5, the investing path. Let's use the $50,000 income target at a 5.5% yield. That gives us a portfolio target of about $910,000. Now, let's assume an 8% annual total return before tax and fees. That return is not guaranteed. It is simply a modeling assumption. If you start at 25 and want about $910,000 by age 60, you need to invest roughly $400 a month. That is still a serious commitment, but time is doing a lot of the heavy lifting. Now, what if you are not 25? What if you start at 40? To reach the same $910,000 by age 60, under the same 8% return assumption, you need to invest roughly $1,550 a month. Same destination, very different pressure. And here is the part that makes compounding feel unfair. At $400 a month and 8% growth, the first $200,000 takes about 18 years. But going from roughly $710,000 to $910,000 can take less than 3 years. The first part feels painfully slow. The last part looks like the portfolio is doing the heavy lifting. That is compounding. The money you invest early buys time. And time is the one thing you cannot salary sacrifice later. What this means for you is that starting late does not mean it is hopeless. It means your monthly contribution has to work harder. Starting early does not mean it is easy. It means time does more of the lifting. But there is one major mistake people make with dividend freedom. They only think about the portfolio outside super. In Australia, that misses half the strategy. Number 6. inside super and outside super. If you are building dividend freedom in Australia, think in two tracks. Track 1 is outside super. This is the money you can access before retirement age. It can fund early retirement, a career break, part-time work, or the years before your super becomes available. Track 2 is inside super. That is the long-term engine. Super has tax advantages. Investment earnings in the accumulation phase are taxed at up to 15%. Investment earnings are generally not taxed when your money is held in a retirement income account. For most people, super income streams received from age 60 are tax-free. But super has one big catch: access. You cannot just pull the money out whenever you feel like it. You generally need to meet a condition of release. So if someone wants dividend freedom at 45, super alone does not solve the problem. But ignoring super is also a mistake. The cleaner picture is a dual-track strategy. Investments outside super build the bridge. Investments inside super build the retirement engine. What this means for you is that your dividend freedom number does not always need to be one giant portfolio sitting in your brokerage account. It can be a combination of accessible investments now and super later. That can make the plan much more realistic. Now, the next question is, what do you actually buy? Number 7, the ETF shortcut. You do not need to pick 25 dividend stocks one by one. You can, but you do not need to. An ETF is simply a basket of investments you can buy in one trade. Instead of betting your income on one bank, one miner, or one insurer, you can own a slice of hundreds of companies. That helps solve the eggs in one basket problem. Here are 4 Australian examples. VAS tracks the S&P ASX 300, has 309 holdings, pays quarterly distributions, and lists a management fee of 0.07% per year. A200 tracks 200 of the largest ASX companies, pays quarterly distributions, and lists management fees and costs of 0.04% per year. IOZ tracks the S&P ASX 200, lists a 0.05% management fee, and its June 2026 fact sheet showed a 12-month trailing yield of 3.52%. VHY is Vanguard's high-yield Australian shares ETF. Its May 2026 fact sheet showed a 4.3% forecast cash dividend yield, a 5.8% forecast grossed-up yield, and a 0.25% management fee. And fees matter. On a $900,000 portfolio, the difference between a 0.04% fee and a 0.07% fee is $270 a year. Not massive, but real. Now, this does not mean one ETF is best. A high-yield ETF may pay more income, but it can also be more concentrated. A broad index ETF may pay less income, but provide broader exposure. Some investors prefer a mix of growth and dividends. Others want more income now. That is why ETF selection is not just about yield. It is about risk, tax, diversification, fees, and whether the strategy fits your time horizon. What this means for you is that ETFs can make a dividend strategy simpler, but simple does not mean risk-free. And that brings us to the trap most beginners fall for. Number 8, the yield trap. A 12% dividend yield looks amazing, until you ask why it is 12%. Dividend yield is simply the annual dividend divided by the share price. So if a company pays a $1 dividend and the share price is $20, the yield is 5%. But if the share price collapses to $8, that same $1 dividend suddenly looks like a 12.5% yield. The yield went up, but not because the business became safer. It went up because the price fell. And sometimes the market is warning you that the dividend may be cut. That is a yield trap. The second trap is franking concentration risk. A lot of Australian dividend income comes from the same familiar sectors: banks, miners, insurers, energy companies, telcos. VHY's May 2026 fact sheet showed 37.6% of the fund invested in financial companies and 26.1% invested in basic materials. Its top 10 holdings represented 67.8% of the ETF. That does not make it bad. It simply means you need to know what you own. If most of your income relies on the same sectors, the same tax settings, and the same franked dividends, then one policy change or sector downturn can hurt more than expected. What this means for you is that chasing the highest yield can be dangerous. A good dividend portfolio is not just high income. It is income you can understand, diversify, and survive with. And now we get to the final piece. The reason dividend investing feels slow at first, then starts to snowball. Number 9. The DRP Snowball. DRP stands for Dividend Reinvestment Plan. Plain English? Instead of receiving the dividend as cash, the dividend automatically buys more units or shares. The ATO still treats the dividend as income. So reinvesting it does not make the tax disappear, but mechanically, it builds the snowball. Imagine a $50,000 portfolio with a 4% cash yield. That produces $2,000 a year in dividends. If you reinvest that $2,000, it buys more units. Those units pay dividends. Those dividends buy more units, and the cycle repeats. At the start, it feels tiny, almost pointless. Then one day, the portfolio is paying for a week of groceries, then a power bill, then a mortgage payment, then a month of expenses. Then maybe, one day, the whole lifestyle. That is dividend freedom. Not instant freedom, not guaranteed freedom, built freedom. The system works slowly before it works suddenly. And the final truth is this. You do not need to wake up tomorrow with $1 million portfolio. You need to know your number. You need to know the tax rules. You need to know the yield you are relying on. You need to avoid the traps. And you need to keep buying the asset that buys you time. Because living off dividends in Australia is not a fantasy, it is a system, and a system rewards the person who starts.